In this video, we want to go over several practice problems pertaining to equity. So let's get started. So here we have Triple Z, developer of radiology equipment, has outstanding stock as follows: 12,000 shares of cumulative preferred, 2% stock, 150 par, 50,000 shares of $10 par common stock. So they tell us that during the first 4 years, their distribution was 27,000, 60,000, 80,000, and 90,000, and we can see that over here on our chart. Now, the key word that we need to be aware of is the word cumulative preferred stock. And this is important because the word cumulative means that this preferred stock is supposed to get an annual distribution or receive an annual distribution of dividends. So what happens is if and when the company does not give out dividends in that particular year, or the amount of dividends that they give out is not enough to cover the cumulative dividends, then the company is in arrears, meaning that they have an IOU to the preferred stockholders. Now, how do we know how much dividends the preferred stockholders are supposed to receive? Well, that's where the 2% comes into play. So what we want to do is we take the 12,000 of shares outstanding and we multiply that by 2%. And that gives us, did I do that right? 12,000 times 0.02. Yeah, that wasn't right. It was 240. There we go. 240 shares. And so what that happens there is we take the 240 and we multiply that by the par value times 150. And that's $36,000 in dividends that they should receive annually. So when the company issues out only $27,000 worth of dividends in the first year, all of the $27,000 goes to the preferred stockholders, and notice that the common stockholders get none. So in year 2, the company declares $60,000 in dividends. So the preferred stockholders gets the $36,000 for the year that they should receive, plus the $9,000 they did not receive in year 1. Okay. So then what's left after that is the $15,000 that the common stockholders receive. In the third year, the company issues out $80,000, so the full $36,000 goes to the preferred stockholders and $44,000 goes to the common stockholders. In year 4, the company does $90,000. Of course, we see the same 36, 36, 36, and whatever's left over goes to the common stockholders, as we can see here. So then the next thing they want us to do is they want us to tabulate or calculate the earnings per share, dividends, or I should say dividends per share. So what that means is the total amount of dividends that the shareholders receive every year should be divided by the shares outstanding. Well, let's take a look at the preferred stockholders first. In year 1, they got $27,000 in dividends, $45,000 in year 2, $36,000 in year 3, and $36,000 in year 4. Remember, the $45,000 is because they had $9,000 in arrears. So the shares that they have outstanding are 12,000 shares. So we see that per share, each shareholder received $2.25 in year 1, $3.75 in year 2, and $3 for years 3 and 4. So for every share that you own, you should have gotten that same amount for each year. For the common stockholders, it's really, really low, which is typical of being a common stockholder. There's so many more shares of common stock, and so they get pennies on a dollar. Imagine how annoying that would be if you received, you own some shares and you only got 10 cents per share in dividend distribution. And so let's say you own, I don't know, 100 shares times 10 cents. That's not a lot. And so that's like, what, $10? Or if you only had 10 shares, 10 cents. So what happens is you have to end up paying taxes on that. And many times, if you're not doing them yourself and you're having a preparer do it, you'll find that you're paying the tax preparer more than the actual dividend that you receive because they charge you per page. So not cool. Anyway, so that's the end of that particular question. Next, Gallatin County Rocks, Inc. is a marble contractor, and they issued for cash 75,000 shares of $45 common stock at $54. And then later on, they issued 20,000 shares of preferred stock. So what they want us to do is to record their journal entries for both activities. So when we're taking a look at the first one, the company issued 75,000 shares of common stock at $54. So remember, the cash that comes in represents the price, the dollar amount that we sold each share for, and we sold each share for $54 based on the market value. And so that ends up being $4,050,000. Now, on the other hand, remember that common stock must always be listed at its par value. Par value or its stated value if it is listed. And so we cannot just say, oh, common stock. No. Remember that common stock must be listed at its par value or its stated value. In this case, the common stock's par value is $45. So those same 75,000 shares must be multiplied by their par value, and that's what we recorded as $3,375,000. So the difference between the two goes down here into our PIC account. I call it PIC. Paid in capital in excess of par common stock. And so that's where the excess above par value is recorded and stored. For the preferred stockholders, the same goes for them. Preferred stock is always listed at the equity, the shares par value. We've never introduced that preferred stock has stated value, so it's just really a par value. So we sold them for $12 per share. That's great. We list that as the cash that was received, $240,000. However, remember that preferred stock must be listed at its par value. So 20,000 times its par value is 200,000. The difference between the two is saved, recorded, and stored in the PIC account, paid in capital in excess of par preferred stock. The next question is, what is the total amount invested by all stockholders as of August the 7th? Well, we add up the shares that we sold for common stock and the shares that we sold as preferred stock, and it comes up to $4,290,000. Helena Carpet is a wholesaler, issued for cash 750,000 shares of no par common stock, but it did have a stated value. So this one has stated value of $1.50. So we sold them for $4 each, and it issued for cash 17,500 shares of preferred stock that had a $50 par. We sold them for $60. So let's record this journal entry. So we see that the cash that came in, the shares that were issued, 750,000 shares at $4, which is the market price. So it's $3 million. Remember, common stock must be listed at the par value. So we take the shares that were sold times their par value, $1.50, and that comes up to $1,125,000. The difference between the two is recorded and stored in the PIC account, paid in capital in excess of stated value, because we don't have par value, but we call it the stated value for common stock. On the 30th, remember, we sold preferred stock. We sold 17,500 shares. We sold them for $60 each according to the market price. And so that brought in $1,050,000. Remember that preferred stock must be listed at its par value. So we recorded and stored it as a credit to preferred stock, 875,000. The difference between the two is recorded and stored in the PIC account, paid in capital in excess of par, preferred stock, 175,000. Please remember that cash is increasing in our business, preferred stock is increasing, that's the amount that we have issued out, and paid in capital is also increasing. So they're all increasing, but remember the equity accounts increase on the credit side and cash increases on the debit side. So what is the total amount invested when we add those up is $4,050,000. In this next example, we have American Lift Corporation. They acquired land in exchange for 5,000 shares of $5 common stock, a $5 par common stock. So here we're seeing a transaction where instead of the company receiving cash for the sale or issuance of stock, we are in turn getting land in exchange. Now what we need to be mindful of is that when the asset that we're receiving does not have the fair market value listed, the asset that we're receiving will assume the current market price of the shares. But if the land had been appraised at, I don't know, $200,000, well then it would be listed at $200,000 and probably would have had less shares going out. All right, so here they did not give us an appraised value for the land, so the land will naturally assume the current market price per share for its value. So the land, they're issuing out 5,000 shares, and so the land will take on the market price per share, and they gave us that. So it's 160,000. Land is increasing in our business. And then we have common stock. Remember that must always be listed at its par value. They gave us that, so we're issuing out 5,000 shares at $5 each, is 25,000. And so the difference between the two is recorded and stored as a credit to the PIC account, paid in capital in excess of par, common stock, 135,000. In this next example, we're taking a look at a summary of transactions that you might see in a corporation, some of them where an asset other than cash is being used in order to issue common stock against, and then we have some preferred stock and some common stock. So let's take a look. Oh, and also we may issue out stock as compensation for services from another entity. So here we have let's see, March the 1st, we issued 220,000 shares of common stock at par for cash. So in other words, these shares are issued at par. They happen, which happens to match what they're being sold for, so it's not like the market price was any random number that we're ignoring. They happen to be the same at that particular time. Go back. So here we see cash came in $2,200,000. Common stock, we listed it for that amount. There is no paid in capital in excess of par because the shares were sold at its par value, which is $10. Also on the 1st, we issued 500 shares of common stock at par to an attorney to pay for legal fees. Apparently we didn't have $5,000 to pay him, so we agreed to give him ownership in the business in exchange for services he rendered. So we place here organizational expenses, $5,000, and then we do common stock, 500 shares at what we sold it for. The exchange that we're doing is at par value, which is $10. In the next one, May 31st, we issued 70,000 shares of common stock in exchange for land, buildings, and equipment with their fair market prices listed. So notice that we list the land and the buildings at that price. So then common stock, then we show that we're issuing out 70,000 shares at par value. So that equates to 700,000. That creates a difference in regards to what we received versus what we are issuing. And so that's $175,000, and that goes to the paid-in capital. The excess recorded and stored as a credit to paid-in capital in excess of par. Then lastly, on July the 1st, we issued 18,000 shares of preferred stock at 110 for cash. So remember, we issue it for the price we sold it, but remember that the preferred stock has a $100 par. So preferred stock must be listed at its par value. So that's $1,800,000. The difference between the two is recorded and stored as a credit to the PIK account, paid-in capital in excess of par preferred stock. So I'm hoping that you're realizing that there's a paid-in capital in excess of par for common stock, and there's a paid-in capital in excess of par for preferred stock. Okay. In this next one, we want to record the declaration, the record, and the payment dates in connection with a cash dividend. Well, first things first, we do not have a entry for the date of record. This is an internal date where the accountants assess the amount of the shares that are being issued and so forth and so on, but we do not do a recording in the journal for that. However, we do record for the date of declaration and the date of payment. So on the date of declaration, the amount that the board has voted and declared that they will pay out as far as dividends total in cash is $135,000. So we debit dividends. So the issuance of dividends is increasing, and so is my obligation, because we are not paying it on that particular date, but we are creating the obligation that we will pay in the future. So that's why we say dividends payable. Then on the payment date, we release it and we decrease the payable account, the liability, and we decrease cash, showing that we have now made good on our declaration and we've made the payment. All right, so in this next problem, we are given some information and we are asked to journalize the entries to record, number one, the declaration of the dividend, making sure to capitalize an amount equal to market value, and the issuance of the stock certificates. Okay, so this is a issuance of stock dividend. Now, sometimes this can be a bit challenging for students, and not that it's a complex concept. It's just that you've got to really pay attention to differentiate how you handle a stock dividend versus a cash dividend. They are treated differently. Do not confuse the two. So here, the declaration of the dividend. So they tell us that the board of directors declared a 2% stock dividend when the market price of the stock is listed at $13 per share. So in order to figure out how many shares they are issuing as dividends, we have to look at the shares outstanding. Now, the problem says that there's 500,000 shares issued, so we're going to make the natural assumption that this also represents the shares outstanding, because that's what you really want. So what we have here is we take the 5,000 shares outstanding, and we multiply that by the indicator. They're doing a 2% stock dividend. So 0.02. So that gives us, 10,000 shares. So they're going to issue out 10,000 shares as dividends. So what is the price of those shares? Well, we take the 10,000 and we multiply that by the market price that they tell us. And so that's $130,000 worth of shares. So that's 10,000 shares at 130,000. So we record a debit to stock dividends. That's increasing the issuance of the stock dividends. But because we are not issuing it today, we use the term distributable. This is a liability account. It would have been nice if they said stock dividends payable. To me, that would make a whole lot more sense. But because we're not paying it, we don't use the word payable. We are going to distribute more stock. So that's why we use the term distributable. Get it? I hope so. So that's a liability. All right, and it's increasing. And so the difference between the two, oh, remember, because it's stock that's being distributed, remember, stock must always be listed at its what? Par value. So the par value is given to us, which is $4 par stock. So for par value times the shares that we're going to issue as stock dividend is 40,000. The difference between the two is recorded and stored as a credit to the PIK account, paid in capital in excess of par, common stock. Okay. The next thing that we need to do, it asks us the issuance of the stock certificate. So now we need to issue it. So on the date that we do issue it, we reduce the payable, so it's going down, 40,000, and we show that common stock is being credited. We're issuing common stock now as a stock dividend, 40,000. All right. And so the question you may ask is, okay, Mrs. Jordan, why is it 40,000 when up here we said 130,000? Why? Here's why. Remember, common stock must always be listed at its what value? At par value. All right. So that's why this is the market price if we had sold it in open market, but this is the par value, and that's what it must be recorded. All right. Awesome. So the next question is determine the following amounts before the stock dividend. So what was our paid in capital before we issued out the stock dividend? So I'm going to go back a little bit and refresh your memory on the accounting equation. So we have the accounting equation, you remember, yep, assets equals liabilities plus equity, right? So I want to remind you that equity is broken up into two major areas. We have retained earnings, and then we have paid in capital. And the idea is that both areas generate capital. Paid in capital generates capital from the sale of stock, whether that is common stock or preferred stock. Then we have a third component here that we talk about later, and that's treasury, and that actually is a contra equity account, and it reduces treasury stock. So that really doesn't count in this conversation, but it is a part of the paid in capital. Then we have retained earnings. And retained earnings is the way that a company raises capital through operations, revenue, expenses, and the issuance of dividends. So remember that expenses and dividends reduce equity. They reduce your total equity. I'm kind of writing all over in here. So we have two major areas. We have the paid-in capital that helps us generate capital by the sale of stock, and then retained earnings that shows that we're raising capital through the sale of goods or services, right? So what was the total paid-in capital before we did the stock dividend? Well, that's easy enough. They tell us that the paid-in let's see, we have the 200,000, which represents the common stock, and then we had the paid-in capital of a million. I'm sorry, 200,000. It's 2 million for the common stock and 1 million for the PIK, paid-in capital in excess of par. Now the PIK is listed in here too. I just didn't have enough room. So the PIK account is also a part of the paid-in capital. So that collectively is $3 million. So our paid-in capital before we did the stock dividend is $3 million. What is our retained earnings before the stock dividend? Well, they tell us it was $33,500,000. All right. So my total stockholders' equity is the addition of those two, right? Paid-in capital plus retained earnings, so that's $36,500,000, and that's what we see here. So what happens to those same values after I issued the stock dividend? Really simply, the dividend area here that we issued reduces my retained earnings. So we see that dividends being issued reduces retained earnings. And how much did we do? It was a market price of 130,000. And then the paid-in capital ended up increasing because common stock 130,000. So we see that there's this big transfer from this area over here to the paid-in capital. So retained earnings was reduced by 130, paid-in capital increased by 130. So we see those values. So we see that the total paid-in capital increased by 130. So we see it now sitting at $3,130,000, whereas the retained earnings has been reduced by 130,000, and so now it's sitting at $33,370,000. So what is the total value of my equity, stockholders' equity? It didn't change. It's still sitting at $36,500,000. Why? Because we just took one type of equity and changed it into another. So total equity is not impacted at all. All right. So just a little bit there. I wanted to point that out to you guys. All right. So the next one we have is bottles and distributions, distributes water, blah, blah, blah. So we want to journalize the transactions of July 9th, September 22nd, and November the 23rd. So here we're dealing with treasury stock. And so a few things that we need to remember about treasury stock. Treasury stock must always be listed at cost. What did we purchase it for originally off the open market? All right, and we keep track of that. And any time that we sell the stock above or below the original cost, it goes to a PIK account, paid-in capital from the sale of treasury. All right. By the way, please remember that treasury stock is a contra equity account, and so that means that it increases with a debit. And of course, that means it decreases with a credit. Right? Very important stuff there, because the idea is treasury stock reduces my equity. If I'm taking the equity that I have and I'm buying it off of the open market, I'm I shouldn't say unissuing it, but I'm bringing it back in, then that releases my equity. Anyway, so here we purchase on the 9th some treasury stock from the open market, our own stock from the open market. There's several reasons why. Sometimes a company wants to buy back those shares and redistribute them as benefits to their employees as some sort of compensation benefit package. Sometimes they do it to show that they have so much confidence in their own stock that they're willing to own it themselves. And then not so much, but before, back in the 80s, when we had a lot of hostile takeovers of one company to another, they would buy up all their stock on the open market to prevent a hostile takeover. That's not really a big issue these days. So here we purchased 40,000 shares at market price, $44 per share. So 1,076,760,000 cash went out. On the 22nd, September the 22nd, we took 30,000 of those shares that we purchased earlier, and we are reissuing them. We're reissuing them at the market price of $50 per share. So this is above cost. So I'm selling them more than what I originally purchased them for off of the open market. So that is going to create a positive value in the PIK account, paid in capital from the sale of treasury. Because remember, any excess or shortage of treasury stock that we resold, again, which is above or below cost, is going to be recorded and paid in capital. If we find that we sold the shares for more than we did, we will credit this account. And so you could say loosely, not, and I hate to use this word, but just to give you an example, you could loosely say that the credit functions as a showing of a gain. A debit to this account loosely shows the loss. Okay. The problem is that this account cannot go below zero. So what that means is if you end up selling the stock so significantly less than what you originally purchased it for, if it's so below cost, then what we're going to have to do is we're going to have to debit retained earnings. If there's not if we're going to find that the loss is going to make the PIK account go below zero, it has to go to retained earnings. So retained earnings will absorb that loss in full. All right, so here we have a gain, so that's good times. So remember, treasury stock must be listed at cost, what we originally purchased it for. So the difference between what I sold it for now and what I purchased it for is recorded as a credit to the PIK account, paid in capital from the sale of treasury stock. Okay. On November the 23rd, we sold the remainder of those shares, but this time we sold it at $43 per share. So it's below cost, below what I originally purchased it for. And so remember that the treasury stock is always recorded at cost, so what we originally purchased it for, $44. The difference between the two, because it's a loss of sorts, we are going to debit the PIK account, paid in capital from the sale of treasury. All right. So the next question is, what would be the balance in the paid in capital account from the sale of treasury? Well, remember we put in there 180,000. By November the 23rd, we had to deduct the loss of selling those treasury shares below cost. So now it's sitting at $170,000. So here we want to take a look at what our transactions do and how they reflect or look on our balance sheet. So they give us several, some information here. And here we see the stockholders' equity section of the balance sheet. So here we have the title paid in capital. Again, going back to what I showed you here, paid in capital, and we have that listed first. And then we go to retained earnings. Remember, paid in capital has the common stock, the preferred stock, and then retained earnings has the revenue revenue expenses and dividends, the net value rolled into retained earnings. All right, so they have the preferred stock listed here. Now this is true for those of you who remember what looking at the 10K looked like, and we were looking at the statement of stockholders equity. We had a little narrative that opened up there when we're talking about shares, saying the percentage of the stock, if there was any par value, how many shares were authorized, and how many shares were issued and outstanding for both the common stock and the preferred stock. So we have that narrative there. That is usually seen on most financial statements for the statement of stockholders equity. And so they gave us this value, $8,000,004. And the excess, that's your PIK account, the paid in capital in excess of par. And so the net value of the preferred stock is $8,610,000. And then here for the common stock is where you would see that information. The common stock is always listed at its par value. Okay, and then any excess is listed in the PIK account, the paid in capital in excess of par. So the difference, or the not the difference, in conjunction together, this is the net value of those shares. Then we have the sale of treasury stock as listed last. And so our total paid in capital is $13,615,000. Now here we have we have one that's a bit more complex. They have thrown in retained earnings on us. And so what we see here is, again, paid in capital. This one does not have preferred stock, so we see common stock listed first in the narrative. The par value, shares authorized, shares issued and outstanding. And then this is our PIK account, paid in capital in excess of par. We add those two together, and that gives us the net value of the common stock. Because we didn't have preferred stock, we can stop there, and then we address the treasury. And so remember, from the sale of treasury, that's what came in. Now, if we saw the amount of value that was reduced from treasury because we purchased 9,000 shares in the open market, that's listed after retained earnings. So we see it further down. So, because remember, this is your PIK account from the sale of treasury stock. So those paid in capital accounts are listed underneath the paid in capital heading. Then we have retained earnings, and then anything that net reduces the equity, stockholders' equity, is listed last. So we add that together, and that's our total paid in capital. Then we add in retained earnings, and so our total here, equity at that moment, is $24 million. Then we deduct out the value that went out because we purchased 9,000 shares at cost. And so our total stockholders' equity is $23,676,000. So here we're talking about a stock split. So they tell us that we had 50,000 shares. And so if we want to know what that looks like, we take the 50,000 shares and multiply it by the 3. Usually you'll find a company who does this because they want to make their shares more affordable. They want to create a rally on the market. And so what they do is, if they feel that their shares are too expensive, they will do a stock split. Microsoft has done this a couple of times over the past 8 years. And so that's what they've done in order to make their shares more affordable for everyone. Now, one thing they don't mention here is what if these shares had a par value? So let's say that the par value um, was $27, okay? And so we had a 3-for-1 split. Well, what happens is we take that par value and we would divide it by 3. So that means that each share would have a $9 par if there was a par value attached to that. How does this impact the market price of the shares? Well, typically you will find that if the market price was, as they gave us, $210, we would divide that by 3 and we will find that the market price of each share will go down. And that was the intent, to make the market shares, the price of the shares less. So here, just taking a view of different transactions that we talked about and how it impacts our accounting equation. So when we're authorizing and issuing stock certificates in a stock split, what does that impact? It doesn't impact assets, liabilities, or stockholders' equity, and that's the reason why we don't journalize the stock split. It doesn't impact the accounting equation at all. It has to do with the market price, really. And so we do not journalize stock splits. So what about declaring a stock dividend? Now remember, this is a declaration. The stock have not been issued. And also remember, this is a stock dividend. So let's focus in our mind, this is a stock. So it doesn't impact assets, liabilities, or stockholders' equity. Well, what happens once the stock is now distributable and it is issued? Does it impact assets? No. Liabilities? No. Equity? No. Because remember, all we're doing in the stockholders' equity is we're transferring the value from retained earnings, and it's going over to the paid in capital. All right. And so it's just a net change in equity, but it does not reduce equity. What about declaring a cash dividend? Now, this is a declaration. It's not the issuing. It doesn't impact assets, but it does impact liabilities because we're declaring, and it creates a liability that says we will pay sometime in the future. And it does decrease the equity account because we are impacting the dividends. Once we do pay it, assets is reduced because cash goes out. Liabilities is reduced because now we've met the obligation, and no net effect in stockholders' equity because it was already taken care of in the declaration. So here we have selected transactions to pretty much sum up many of the transactions that we've talked about in this lesson. And so the first one is that we did a stock split, a 2-for-1, which reduced the par from $80 to $40. That's because we divided by 2. And then after the stock split, there were 150,000 common shares outstanding. Now, we do need to remember that for later on. We do not record an entry. So remember that we do not record a journal entry for stock splits. Next one, declared semi-annual dividends, 75 cents for the preferred stock, 28 cents for the common stock. So this is a declaration, not a payment. So what happens is we take the 18,000 shares outstanding and multiply that by the value of the dividends per share that we promised to pay. And so that's 55,500. Oh, and that also includes the 150,000 shares outstanding of the common stock against the 28 cents that we promised to pay. So we add those two values together and we come up with $55,500 in cash dividends that we promised to issue. And so we credit dividends payable because we're just doing a declaration, not payment. Well, on July the 1st, we finally do a payment. So we reduce the cash dividends payable, and we also reduce cash, showing that we've now made good on the declaration for the dividends. On October the 31st, we declared again semi-annual dividends. So this apparently is happening every 6 months. Must be nice. I need to be a part of this. 75 cents for preferred stock and 14 cents on the common stock. In addition, and here's the kicker, we're doing a 5% common stock dividend. So remember, the shares outstanding at this moment, we are now up to 150 shares outstanding. So the 150,000 times the 5%, so that comes up to 7,500 shares that we are issuing as stock dividends. The fair market price is $52 per share. So in this particular transaction, we record the cash dividends that we are declaring. So remember, we're declaring, we're not paying them. So that's the 75 cents times the shares outstanding for preferred stock, and then the 14 cents per share for the common stock at 150. We add those two together, and so that's 34,500, and we debit cash dividends payable, credit, to show that we will pay in the future. For the stock dividends that we promised to issue, we come up with the 7,500 shares that we're issuing times the market value, which is $52, and that comes up to $390,000 worth of stock that will be issued as stock dividends. Remember that common stock, or our stocks, must be listed at its par value when available. This stock does have a par value of $40. Remember, we did the stock split, so it's not 80 anymore, it's now $40. So we go in and say the 7,500 shares that we're going to issue at the $40 par is 300,000. The difference between the two is recorded as a credit and stored in the paid-in capital in excess of par common stock. On December 31st, we pay out the cash dividends and we issue the stock dividends. So here we have the cash dividends being paid and the stock dividends being paid. Remember, the word distributable makes this a liability, a promise to issue. And I hope that this was helpful.